Okay, it is 11 o'clock. Welcome to this week's show. I'm actually going to hand over now to Richard because literally all the news this week was all about property. So I'll let him run through the news and then I'll be back again in about 10 minutes or so and talking to Sandy Nairn and Anna Bartlett of Global Opportunities Trust. So over to you, Richard.
Thanks, James. Yeah, so a lot of real estate news this week, and as has been the case for the last couple of years, it's all dominated by M&A activity. So first of all, we'll look at Assura. So this has been sort of ongoing for a couple of months now. Sort of a bidding war sort of broken out for Assura. So it started with KKR coming in with an offer, and then PHP, which is its listed peer, so coming in with a counter offer. So this week there's been a couple of developments on that. So earlier this week, KKR and Stonepeak came back with a final and best offer, which the board of Assura's recommended. So in all, including the dividends within that, comes out 52.1p, which implies a value of just under 1.7 billion, and that's a nice little premium to the to Assura's NAV of 50.4p. And interestingly, they switched over to a takeover offer from the scheme, which only requires 50% of support for it to go through from shareholders. So, as I said, Assura's board has recommended this. They believe it's a compelling opportunity for shareholders to come out and realise their investment, and is significantly less risky than the PHP offer, which I'll go into detail in a moment, and the board will share their votes, but it's only 0.1%. So just to recap on PHP's offer, which is obviously still on the table. So it's part cash, part shares, as you can see there, and based on its share price last night, it implies a value of 53p, which is a small premium to what KKR's offer is. And they also said that should Assura declare a special dividend, then it won't lower its price. So Assura came out earlier this week when it recommended the new KKR offer, came out with details of why it believes that one is superior to the PHP offer. And most of its reasons are here. So significant leverage, so LTV will go over 50%, and PHP are utilising a 1.2 or just over 1.2 billion acquisition facility to for the cash element of this deal. The combined group would have 2 billion of refinancings due in the next 2 to 3 years. Execution risk. So obviously PHP need to sell some of the assets to pay down the finance. So there's execution risk there. One of the things that they are going to sell, they've already said they're going to sell, is a stake in the private hospitals portfolio. That is all inflation linked. So there's a loss of that sort of guaranteed inflation linked uplift every year in the rents. Most of PHP's is open market rent, which obviously comes with its own risk, but also rewards in good markets. And there's integration risk with the two teams coming together, and there's a potential for a CMA review as well, because the combined portfolio is for 6 billion, so it does present risk there as well. So this morning PHP responded to these concerns, but also raised that through their conversation so far with Assura that they're concerned about the responsiveness and the objectiveness of Assura in this process, which is interesting. But they outlined their plans to sell the stake in the private hospitals, as I mentioned before, which they will do in a sort of JV. So they sell a stake and they'll retain part of it and retain the management contract, so they get fees from that. And they say they've already received strong interest on that and other properties within its portfolio. It's confident that these transactions would reduce the LTV in the short term below 50%, which is its limit. Expects investment grade credit rating, which Assura has got, so it expects to sort of keep that when the two companies merge. And it's got a track record of doing exactly this type of thing before in 2019 with Medics. And it believes it's already sort of started to talk to CMA, and it believes that there won't be any sort of competition issues there. But obviously, we don't know that for sure. So, I mean, shareholders have got to make a decision now, I think, that whether to take the money that's on the table, which, like I mentioned earlier, is above net asset value, or if they want to stay in primary healthcare, then to push for this deal. I mean, what I would say is that the sector is at the bottom of the market in terms of values, so you'd be giving up the sort of uplift coming through on that. But it's also at a great time with the new Labour government bringing in plans to move NHS care back into the communities, and that means away from hospitals and into the settings that PHP and Assura own, so sort of health centres and GP surgeries and things like that, and that will mean a huge uplift in investment in that sector, and it will mean that the government will have to up the rents that they pay the landlords. So there's significant uplift potential there. So, but then I agree with Assura that there's a lot of execution risk involved in selling these properties, and also there'd be a known sort of forced seller in a way. So the prices and the terms that they'll get are not guaranteed. So that's the conundrum for shareholders on that one. We look at PRS REIT now. So this has been another one that's ongoing for quite some time now, since sort of the middle of last year. So you can see its share price and NAV table there over the last 5 years. NAV's been coming on nicely. Share price was dwindling away until, as I said, midpoint of last year, when a number of things arose. So in August, they received a requisition notice from a group of shareholders. That was after the company awarded a multi-year contract to the manager, sort of 2.5 years, which is sort of unheard of in this sector. It's normally 1 year, and they've also believed the board hadn't done enough to bring the NAV, bring the discount to NAV in. So shareholders got that won that battle. The chairman was replaced by Rob Naylor, and Chris Mills joined the board as well. They're the guys behind Achilles, which was launched since this. And they managed to win the day here, and a strategic review was launched. And the outcome of that is that it put itself up for sale at the end of October. So fast forward, there's been a lot of sort of speculation about who were coming in and what price they would receive. There was a news story this week, I think it was Sky, that broke it, that a possible cash offer had come in from Long Harbour, which is a UK real estate firm, valued it at 115p, which seems far too cheap for me, having looked at the portfolio, and it seems that investors were expecting more as well, because the share price had gone up to sort of 118.8. So that's now obviously come back down again. And if you look at their NAV, it's sort of just under 140p. That was at the end of December. They've pretty much completed all their homes now under development. That's worth 1.2 billion. And the private rented sector is in rude health at the moment. So the dynamics, obviously everyone knows the lack of supply of housing in the UK. Affordability as well means that there's a high demand for rented homes. These are family homes, they're not flats. These are sort of 2, 3, 4 bedroom homes. And that all equates to rental growth, and this company has been posting like double figure of rental growth over the past few years. So that tells me that this offer is undervaluing the company, and although the board has sort of acknowledged it, they haven't sort of come back with which way they're going to go, and I would hope that they'd reject this, and some more offers will come in at a much higher price. And then moving on, last one on Warehouse REIT. So you can see the chart there. This isn't too dissimilar to a lot of property companies. So going nicely until the interest rate spiked, and then you see the big fall there at the sort of early 2023 or late 22, and it's sort of been bumping along. You see the spike in the share price earlier this year, and that's after it received an offer from Blackstone. So this is its sort of history. So in early March, it rejected the initial Blackstone offer of 110p, 110.5p. They came back with a new offer at 115p, and the board said it was minded to recommend that. During the due diligence process, they found a discrepancy with the valuation of one of Warehouse REIT's development assets called Radway Green in Crewe, and they disputed that, and then they came back a few weeks later with a reduced offer, pretty much back at the same terms of the original bid, which was rejected. And the company are now recommending that to shareholders. What's interesting is, this week they published their annual results to the end of March, and it just shows the NAV uplift to 128p compared to the new bid of 110.6, and valuations going up nicely, and estimated rental values going up on their portfolio almost 7%. It just shows that we're coming out of the bottom of the market now, and this is across real estate, and to be selling the portfolios or the companies at bottom of the market prices doesn't make any sense to me whatsoever. The reversion potential there, so that means that the rents that it's achieving versus the rents that they could get today if it was renegotiated is 25%, which is a massive uplift potential there, which you'd also be giving away. But the chair in this statement said that basically the persistent discount to NAV has meant that they've had to, well, one, they become a target of private equity, and then two, they feel that they have to accept this offer because they've been battling so long and not had any turnaround. But it seems to me that it's not the right time, like I said, at the bottom of the market to be taking offers at this low, but they seem to be recommending that. We'll see what shareholders think when they come to vote. Back to you, James.
Great, thank you very much, Richard. No questions on that. Well done. So we're going to move on now and talk to the managers of Global Opportunities Trust. I'm very pleased to welcome Alan and Sandy. So I will hand over to them and let them tell us about the trust, please, and what it's trying to achieve.
Great, thanks, James, and good morning, everybody. So my name is Sandy Nairn. As James said, you've got Alan and myself with you today. We're two of the three managers in the trust. In addition, I'm the investment director because it's a self-managed trust. I'm going to do a fairly brief preamble and then pass over to Alan, who can flesh out the points, give you a bit more detail on our thinking. So in the preamble, there's really kind of three elements to it. The first is just a slight refresher on what the Global Opportunities Trust was, and then there was a significant change at the end of 2021 in investment policy. So why did we want that change? And then thirdly, if you like, how did it change? So let me go to the first of those three, what it was. So when it was launched in 2003, we deliberately set the investment policy to give us what we thought was enough flexibility to deal with most expected market conditions, with the ability to put some private equity in, with the ability to, which we didn't actually utilize for various reasons, with the ability to run up cash balances if we couldn't find cheap assets. And that was all fine up until 2007 and the global financial crisis. It was enough to allow us to navigate what happened in markets. But post the financial crisis, with the interest rate suppression, with QE, and the asset inflation that we saw in the world, we came to the view that the flexibility in the investment policy wasn't sufficient to deal with what we call or what many people now call the everything bubble. So what we had there were cyclically high valuations in equities, we had negative yields in bonds, and then on top of that we had glowing leverage in government debt as governments fiscally expanded, and we had, because of the interest rate suppression, rapid expansion in leverage in private in the private sector, in the private markets. So we could probably have dealt with that if it were not compounded by some of the structural changes that have been gradually unfolding, many of which are known, but not necessarily the impact of them thought through properly. So when Alan comes on and talks about the four forces, I'm only going to mention two of them here. One of them is population growth. As you're probably aware, most developed economies are now aging societies. Population growth is slowing. In fact, the only continent where population growth is rising is Africa. Why is this relevant? Well, it's relevant because it changes the structural element of growth in the economy. Global growth has averaged around 4%, but 40% of that's been down to population growth. Take the population growth away, GDP growth falls, then you expect the potential for profits growth to fall, not necessarily directly in line, but it will certainly fall. So the historic view of 6 to 7% real earnings per share growth is not, in our view, going to be reached, and it could fall significantly. So when you put those things together, what it gives you is a position where you have cyclically high valuations at the moment, you have leverage, and then you structurally are expecting lower growth. And what that implies for the management of portfolios is we believe significant, because it suggests that aggregate returns will be lower, volatility will be higher, and you're going to have to be a lot more agile in what you're doing to manage your portfolio. So for those reasons, we sought greater flexibility in investment policies so that we could manage the portfolio to take advantage of the opportunities that are likely to appear. So that's the second piece of it. Why did we change? And then the third piece is how. And the how piece gets to both how we are doing things, but also the people that are involved in what we're doing in the portfolio team. So I mentioned, obviously, Alan and the skills that he brings in portfolio management per se, as well as stock picking, and James's resume is there, and at some point we'll give everybody an opportunity to chat to James, although many of you will know him from his track record. But just to say here, one of the lessons from experience, and which is particularly relevant in the changing nature of things now, is making sure you have access to the whole range of skills, from people who are good at small, mid, value investing, and I use that in a wider definition, but also people skilled at identifying companies with good growth prospects, and Alan can talk about that as well. So we're excited about the team that's coming together to manage the trust. But rather than me say more at the moment, I think it's probably best just to pass over to Alan, who can flesh out some of the things that the two things I've mentioned, and the other areas that are going to be important to the running of your assets.
Thanks, Andy. I'll try and race through a few things. Sort of beholding on us, I guess, to put up a track record since the changes that Andy talked about. The track record is shown on this slide. It was sort of a little ahead of the MSCI world. Not that we really pay much attention to it, to be perfectly honest, with a half to a third of market volatility and actually negative correlation to equity markets. So we'd be quite happy if we could keep that going for the next 10 years. But to be honest, the strategy for the trust isn't to be permanently low volatility or permanently low correlation to equity markets. It's to flex the risk depending on the availability of opportunities. So in simple terms, if we have lots of investment ideas that are compelling, we're willing to tolerate more market risk. And if we don't have lots of fantastic investment ideas, we think it's kind of silly to force ourselves to be fully invested, and we focus more on downside protection. And the key, if you like, to being able to do that legitimately in our minds is to have a sort of melting pot of research, to have, as Sandy talked about, a really strong team that covers everything from growth to value to large to small, because it means if we can't find enough really high conviction ideas to justify being very long market risk, we just shouldn't do that. And I think that's probably the key differentiating feature of the strategy, is that we seek to take responsibility both for the risk and the return, rather than the return and let clients decide whether they want equity market risk or not. And we're trying to take responsibility for that and navigate cycles for investors in the trust. So the strategy itself, in simple terms, is trying to make money. It's trying to make real absolute returns over the longer term. It's trying to do it with two key features, being the flexibility to adjust and adapt the risk profile, but as important is the willingness and the ability to focus in on specific opportunities rather than give general exposure to markets. We're trying to pick out individual attractive, compelling investment opportunities and then put those together in a portfolio. The risk return profile of the strategy, we think, is somewhere between a long biased hedge fund and more sort of flexible strategies, the sort of flexible multi-asset strategies, but it's largely equity only, albeit there is flexibility to invest in other things, but we're an equity team predominantly, and that's where we think we can generate the most attractive returns. Sandy mentioned the four forces, and I think it's worth a little bit of time to talk about this, because whilst it's all pretty basic stuff, and I think everybody understands this, thinking about it in this kind of framework tends to make it seem more significant, and we think it is very significant. So if you take the sort of 30 odd years up to COVID, for example, that was a period of globalization, which was essentially empowered by these four forces. The rising workforce courtesy of emerging markets, so the demographic profile is very supportive. That made it possible to make stuff cheaper, basically. There were more people that were willing to work for less money, so there's a deflationary impact and very positive for the potential to produce things if you can manage extended supply chains, and movements in advances in logistics and technology made that possible. And against the backdrop of post fall of the Berlin Wall, where running extended supply chains, running the risks of that geographically were less significant than they might be in other environments, because we didn't have to worry as much about protecting supply chains in a military sense. And in this wonderfully naive world that we lived in, where we could just treat the world's natural resources as free, and so not incorporate the real effective price of pollution, etc., into asset prices. Like an amazingly sort of supportive environment for globalization, but given how positive that was, it's frankly bizarre if you think about it, that economic growth over that period was less than 3% per annum. Equity market returns were 10-ish% per annum nominal and 5 to 6% real, but economic growth was less than half of that. And the reason for that gap, we think, is quite simple. It was the deflationary impact of globalization meant that we didn't have inflation, and taxes fell, and frankly most of that excess return on equity markets over multi-decades can just be explained by falling interest rates and falling taxes. And the problem is that 3 of the 4 forces are moving in reverse. Demographics, clearly, only Africa is not aging, and most countries are going to be aging quickly from here. The security environment's changed significantly, obviously military, but also just political, geopolitical attitudes towards things like exporting intellectual capital. COVID showed us all how the risks of having extended supply chains, and so the counter themes for that are frankly not positive for economic growth. And we do need to think about environmental damage and incorporate the real price of externalities into assets and into productivity. And that's not a positive for conventional economic growth, even though it's absolutely a positive for the chances of my children's children actually having a world that they can live in and air they can breathe. We are hugely positive on artificial intelligence and the fact that, I mean, it really is another industrial revolution, but everyone seems to focus on that rather than the other things that counterbalance it. And you put all that lot together, it doesn't seem logical that we're going to go into a period of wonderful inflection positive in economic growth. And then we think you're past the tipping point, basically. I mean, you can look at the madness of what Trump's up at the moment, but there's actually some real things behind it in terms of just the US economic position just not being sustainable on a forward-looking basis. And market valuations are expensive, but there are a lot of other things going on where you can see that it's essentially the 4 forces at work. I mean, we've seen over the last 24 hours what's happened with Iran, etc. These are all just byproducts of these things to us, really, and it's the new normal. And in that kind of environment, you just need to be more flexible. You need to be able to adapt, because we're going to have more market cycles, we're going to have more interest rate cycles, we're going to have shorter cycles and things that mean you need to be able to adapt more quickly, rather than just take a 15-year view that quality is going to generate, quality factor is going to generate an attractive return for investors. And so from our perspective, the 30 years up to COVID, it was perfectly logical for investors to invest passively, to just hang into broad market exposures, and it generated a wonderful return. But if you want to generate those kind of returns on a forward-looking basis, you need to move away from passive, away from ETFs, towards active, and specifically towards active strategies that can be more flexible, more adaptive to the environment, and that rather than give exposure to broad markets, that focus in on individual attractive investment opportunities. So when we look at the world today, building a portfolio has 3 kind of key challenges. The first is it's really easy to find things that look like they're cheap relative to other things, whether it's large versus small, US versus non-US, etc. Very easy, but entirely unhelpful, frankly, if you're trying to generate an absolute return. Most of the really good ideas that we have that could make a lot of money over the next 5 years come with a healthy dose of economic cyclicality. And so if you're positive on the macro, then that's a good thing, and that's easy. We should have more market exposure, but we're not positive on the macro, and even Elon Musk is telling us the truth on this one. You take just what he's been talking about recently is a theme that we've talked about a lot, which is the fact that the US, you can't go from 8% of the tax take in the US being spent on paying interest on the national debt to 25%. It just doesn't work. The math doesn't work, and something has to happen to rebalance that. And the solution that everyone would like, which is that US GDP growth doubles, it's not going to happen. So how that unfolds is difficult to tell, but it's going to unfold. And what that does is it cautions you, I think, or should caution you on the amount of risk that you take in a portfolio. So final slide, the GOT portfolio today, it's pretty conservatively positioned, but not extreme conservative. We are very bullish, frankly, on the ability to generate attractive returns in lots of areas. Our European value stocks we think are very cheap. We think there's still a wonderful opportunity in Japan, which is still a 10+ year cycle of hugely undervalued and misunderstood corporate governance reform agenda. We were very early on the defence theme. We've built quite a lot of exposure to it directly and indirectly through things like oil. Even Alibaba has a geopolitical sort of angle to it, and we think that's still got a long way to go. But overall, the portfolio is very conservatively positioned. We want to be able to take advantage of weakness in markets rather than be paralyzed, if you like, by when volatility makes things a bit more difficult. We're ready to pounce on the opportunities, if you like, as they come along, and confident that we can do that, given that we have a 9-person global equity team that hunts around looking for lots of interesting ideas. I'm done. I was told to talk for 15 minutes. I can do 50.
Cool. Thank you. So we just need to bring me back in again, but here I am. So I have got some questions for you. So let's start with, actually, I know it's a bit short-termist, but can you just talk us through the experience of the last couple of months and what happened with Liberation Day and the tariffs and things, and with your portfolio?
We didn't do very much, to be honest.
Yeah,
I think.
But how did it perform?
We've done pretty well this year. I think we're up 6 or 7% absolute. Broad equity markets are sort of flat. We did particularly well in January, February, but to be honest, for a global equity strategy that has any kind of valuation angle, January, February wasn't a particularly difficult period because the US underperformed so much, and so we did very well there. But as sort of reverse happened and the US came back, we hung on to it, if you like. And a lot of I think part of the benefit of the framework that we think about, the 4 forces type thing, is it is a longer term framework. So when we say flexible, we don't mean that we've got high turnover. I don't think we had any turnover in 2022. When you've got a portfolio positioned as you want it to be, turnover is just a tax because it costs money to buy and sell things. So we haven't really had to do very much because what's been going on, unfortunately, is entirely in line with the bigger picture sort of framework and views that we have on what's going on in the world. We did trim Panasonic, and we sold Panasonic and Samsung. Panasonic hadn't been a good investment for the year before we sold it. Samsung hadn't. Panasonic had been very good, but both of them have sort of issues around tariffs and consumer exposure, and we really don't want consumer exposure, and so we did get rid of those, but that wasn't really, we didn't have to make any big changes. Maybe we should have, but we didn't.
And actually, somebody's observed that your share price is sort of hovering around 1-year highs, which is obviously good news. So what's been driving the sort of positive returns then?
I think the performance has been a little differentiated, so hopefully that's had something to do with it. I mean, it's a small trust, so we know we're not hugely important in the grand scheme of things, but the performance looks a bit different, and I think we really do just ignore the composition of equity markets when we build this strategy, and we try and think very much from first principles, and we've spent a lot of time trying to think about how the portfolio perform in different scenarios, and so at times it can perform very differently to other strategies. Sometimes that makes us look a bit cleverer than we are, and other times it makes us look a bit more stupid than hopefully we are, but it kind of evens out into something that makes sense over the longer term. But I think we've been quite different this year, and maybe that helps a little.
So given your desire to be kind of flexible in the way you approach things, what's the attitude towards holding more illiquid things like small caps, and what proportion of the portfolio is in small caps now?
Well, one of the benefits, obviously, of being a closed-end investment trust is that we can take on illiquidity, but we're careful about it. It's got to be warranted, if you like. When we see opportunities that are only possible to take advantage of if you have more tolerance for illiquidity, then we have a great deal more flexibility to do that than an open-ended fund would have. But overall, the portfolio is very liquid, and it helps, if you like, that the trust is pretty small, so we can invest in some pretty small companies without having a meaningful impact. The smaller cap exposure that we've got at the moment or the smallest exposure is in Japan, but we do have a few smaller things elsewhere.
You mentioned AI. Do you have any sort of direct exposure to the companies that have been benefiting from the AI story? And how would you like to play that going forward?
Not a great deal. I mean, Sandy's been doing an awful lot of work on AI in particular, trying to think about where business models are going to be improved or negatively affected by developments in AI. Sandy, do you want to jump in and add to
Yeah,
that?
sure. So obviously there's two sides of the coin. There's the beneficiaries, and then there's the people on the other side of it. And even some of the beneficiaries will be harmed in the short run before the benefits start to flow through. I mean, a lot of my time has been spent actually in things we can't invest in at the moment that are in the early stage VC tech space, where I've been meeting companies and using historic contacts to try and understand where the disruption they're going to cause is going to flow through, and then ultimately who benefits from it. So, the early stages of this has always been, it's a bit like, I'm going to slightly overstate it, the kind of early days of the internet, where you bought the capex companies, so the companies that made the stuff that built the network, and then you stayed away from the people spending the money on it. And then once that had been, their share prices had come down, had been amortized, you then bought them because they were the ultimate beneficiaries. So it's a little bit like that at the moment. And the returns in the stock market have been focused on, if you like, the nuts and bolts of it, the Nvidias of the world and the AMDs, and also on, and everybody knows the large US companies, but the Magnificent Six or Seven or whatever it is. One of the issues there is that the AI they're developing is, at least in part, I believe, to protect the advertising revenue generation. So it's not new revenues, it's protecting old, and they have no choice. It doesn't mean that it can't be incremental, but it's it's kind of a fight to the death between them on it. So I haven't seen things there that I would rush. I mean, it's not like the internet bubble where you could say certain companies were definitively expensive under any circumstances. I think Nvidia is expensive, but it's possible that it's not. And the reason I think it is because I don't think it sustains the margins, and there's new processor companies coming through that specialize on particular aspects of AI, and they'll kind of nibble away. So there's not much there at the moment in the positive sense of saying, let's go and buy it. But there are going to be companies who utilize the tools in the coming 5 years. It will make a significant difference to their cost base. Probably also brings their revenue down because they'll hit the pricing line. But I think that the one thing you do know is you have to be aware on both the positive and the negative side, because there's going to be both. And I think you need to understand the companies that are going to come to the market. And in order to do that, you kind of want to be in the weeds looking at them. And so that's, it's a bit like the feet are paddling under the water, but it's not obvious what we're doing with it.
Well,
But
one
I am.
big thing, Andy, is we brought in two people that are very good stock pickers in the whole technology and growth space, and it's probably pretty well known that Sandy's a value guy. I'm a value investor, so we're going to struggle with the valuations and frankly just the domain knowledge in the universe of higher growth stocks. And so Russell Champion and Andrew Heap, that joined us sort of 5 months or so ago, and they're real specialists in this area. And the wonderful thing when they joined was that they weren't pushing to buy lots of those stocks, frankly sitting there thinking we're going to have a correction, and so just wait. And so sometimes the best thing is to not invest in something, but long term we know we want to be exposed, so we're doing a lot of work and trying to really understand the space and where the opportunities are going to come from. But it is a case often in investing of it's what you don't own that adds almost as much value as what you do own. And so we try to be within the strategy. We try and only invest in 6 to 10 themes, and which sounds a little arbitrary, and it is somewhat. But the idea is to just be very disciplined. So it's incredibly easy for an investor to become a stamp collector. You just sort of find lots of different interesting things. You just buy them, and individually they all make sense. in the portfolio in aggregate doesn't really make sense. And actually what actually happens is you just end up with a correlation to the equity market that you didn't want. And so we try to be very disciplined about that. So when we add that theme, and we will at some point, it will be very deliberate and in a way that is designed to not create correlation with markets.
Brilliant, thank you. There's a couple of questions. Well, there's a question here about some stocks. So Dassault is one of them. So obviously that's defence. He's linking it with Jet 2, but because they're both so linked to aviation. But I think they're different themes. Is that right?
Yeah, Dassault's got a core business is making, well, on the defence side, fighter jets. It's, I mean, it had some issues a little while ago because one of its planes got shot down. There were a few jokes going around the office about why you should never buy a French car, to be honest. But it's the best fighter jet produced in Europe. It's not as good as the F-35. It's not the sort of generation 4. It's generation 3.5. But it's got a very strong order book, and you know, you essentially know what the earnings for that part of the business are going to be long term. The piece that you're getting that's really attractive and at a significant discount is that it owns 25% of Thales, which brings exposure more to defense technology, space, and other things. And the core Dassault business doesn't have that much operating leverage because it's essentially sold out in its core business for the next 5 years. But what it does have is sort of certainty, if you like, over earnings. The operating leverage is more on the Thales side, and Dassault trades at a significant discount to Thales, which is separately listed. So you get that a bit cheaper than if you bought it directly, which, you know, we can't help it. We're sort of value people. We like getting things cheaper.
And Jet 2?
And that's a tricky one. It was a tricky one for me, in that I sort of always thought that airlines are, you know, not very attractive long-term investments. But it's if you look at it as an airline, you get one sort of framing of view. If you look at it as a vertically integrated holiday company, you get another. And it's just a well-run company that has provides a good service to clients, that has significant growth opportunity. And by luck or judgment, they ended up with a mix of planes that gives them a bit of an advantage against some of the competitors. They bought the last generation of the A320 jets, for example. You know, think of it as if you were, you know, Volkswagen Golf goes from Mark 8 to Mark 8.5 before it goes to Mark 9. They basically bought the Golf Mark 8.5 at a discount because the Mark 9 was about to come out, and the Mark 9 was the 737 MAX on the Boeing side, and the A320 Neo on the other side, both of which have issues, if you like. So they kind of got lucky, I suspect, on that. But what it meant is they've been able to expand a bit faster than others, and have done very well. They also did a dilutive capital raise in COVID, which put 2 billion of cash on their balance sheet. And so they've got an absolute fortress balance sheet, and X the net cash. It's cheap as chips, I think, is the technical term. So cheap as chips and growing double digits is a nice combination. It has cyclicality, and it's down today on, you know, what's going on in Iran, etc. So it does sort of bump around a bit with sentiment, but we think, you know, on a medium-term basis, it's a, you know, very significant upside.
Brilliant, that makes sense. Now, with sort of aging populations, and it's often sort of argued healthcare should benefit. Is that a theme within the portfolio? And if not, why not?
It has been. I think, when did we sell our healthcare stocks, Andy? Mainly the back end of 22, because they got really expensive.
Yeah.
We've been kind of nervous about just the policy side of things, because obviously, if you think about things from the four forces sort of perspective, we're going to have a lot more old people that need a lot of healthcare, and that governments can't afford to pay for. And so when that's a very obvious and very well-known theme, but it makes you cautious about over-believing in the defensiveness of those kind of companies, because they have event risk issues. Where we think that there's really interesting opportunities is more on the sort of more med tech side of things, and Russ Champion in our team is like a proper expert in that, and been really doing a lot of work, and that's where AI could have amazing benefits to humanity over the coming decades. And certainly that you've been doing a lot of work on that, Sandy, haven't you?
Yeah, I mean, AI is going to be ever more pervasive in its impacts in terms of potential cost reductions. And the UK actually has a big advantage because it's got a health service. And because it's got a health service, it's got centralized data. And because it's got centralized data, you can run neural networks on it, and both diagnostics and prescriptions and so forth. But in the technical equipment, I mean, just to give you an example, there's a business I know where you can take the bottom end MRI scan, upgrade it to the top end just through an algorithm, and that's a 1 million machine versus a 7 million machine. I think, as Alan said, the area to be careful of is that we know there's differential drug pricing. We know both the Democrats and the Republicans, whatever happens, are going to have to find cost reductions. And the pharmaceutical industry has been very good at protecting itself, but it can't do it indefinitely. So you could see some serious price cutting in prescription drugs and the way they treat some of the IP. So you're absolutely right. The structure of the economy is shifting because of the aging population, but it's not necessarily the drug companies, and certainly set against the valuations. I mean, they'd been bumped up because they were viewed as safe and repeatable, and that trade just didn't make any sense anymore. It doesn't mean we won't go back to them, but there's a range of things happening that are interesting, and I think AI is going to be one of the leaders in that.
In general, it's quite hard at the moment to find sort of resilient defensive stocks that are sensibly priced. People get very excited about all the defense companies going up a lot and tech going up and down, but quietly in the background, a lot of the things that you would traditionally go to as sort of reliable defensive stocks have gone up a lot, and I think that is telling you something. It's not all excitement around things. There's been a significant re-rating in resilience as a theme. The challenge for us then is the risk return just moves away from us a little. So we're struggling to find things that make sense in that sort of space, which is food for thought.
Yeah. Which leads us on to, there's a question that comes up quite a lot when we do these things, which is the role of cash in the portfolio. So you've got a lot of cash. So how do you manage that exposure? How long will you have it for? When will you deploy it? That sort of thing.
You can kind of think of it as a residual of the conviction in the underlying stocks. So it's kind of curious, if you like, that in the global equity world, people are used to thinking of cash as being a sort of frictional asset, and it's the client's responsibility, if you like, to decide how much they want to deploy, and the fund manager should just be fully invested. But then they put money in bond funds where they might have significant exposure to really short duration bonds, which is essentially cash, or hedge funds where they might be 95% cash and using derivatives to get exposure long and short to stocks. So I think it's one of those areas where a more nuanced understanding of the role of cash in portfolios actually is quite warranted. You can use cash offensively, for example, as to counterbalance a portfolio. If you own 20 or 30% cash in a portfolio, that helps to reduce your overall risk. So, for example, that could enable you to buy higher beta stocks and end up with a portfolio that had the same kind of market exposure as the market, but with 30% cash in it. And so that's not what we're doing at the moment. But actually, if you think about what we were just talking about with resilient stocks, that's if we've sold a couple of resilient stocks and bought cyclicals, but with the cyclicals we bought were about a third of the weight of the defensive sort of resilient stocks that we sold, to kind of keep the overall risk profile of the portfolio the same, but tilt more towards things that we thought had more upside, rather than be forced, if you like, to keep holding defensive stocks because the alternative wasn't available to us. So the cash gives us a bit more flexibility, and at the moment, given you can get a real yield on cash, it's not a bad asset to own, but it will flex over time and we do, if we were very bullish, the cash could be down to zero, for example, and we think that that's a positive thing. That if the ability to flex the risk profile of the strategy from an absolute perspective is a key strength, positive for the underlying strategy, we think. Another side of it, if you like, is that if you're running a fully invested portfolio and markets get bouncy, you have to sell something to buy something, and that can slow down your ability to take advantage of compelling opportunities. We just don't have that problem. If something comes up, someone's block trading a stock and it gaps down 10% and we wanted to own it, we can just buy it straight away. There's no issues. So it's got a lot more dimensions to it, I think, than people typically talk about. And partly, if you think about it, is that I think people have just been terrified of lagging markets for so long, that clearly if you're very index oriented, then you just will replicate the index exposure, including having no cash, basically. And that's actually been a great strategy for the last 30 years because markets have just gone up and larger caps have outperformed small caps, etc. So risk, if you like, has been in stepping away from indices. Well, we think on a forward-looking basis, risk is not stepping away from indices, and so cash just gives us more flexibility.
Great, thank you. That's a much more comprehensive answer than we normally get.
Right.
No, on a good way. So two linked questions, really, maybe just to finish up with. So one is, why do you think the discount is as wide as it is? And also, do you have an investment in the trust?
So let me pick up on that one. Yeah, I mean, Alan and I have got pretty much all our savings in it, so
Yeah.
so significant amounts in the trust, and actually one way of thinking about the trust is it's a representation of how we want to manage our money. I mean, that's because that's exactly what it's doing. So sometimes you even think about it as being like a mini family office where we're getting access to a whole range of things, but at a much reduced cost. In terms of the discount, I mean, it did blow out. I mean, it's come in a little bit, but it's still pretty high. I mean, I think, as you know, there's a whole bunch of structural things in the industry about you need to be a certain size to be of interest. But I think, what we're trying to do is, I mean, we want the discount in, obviously. We'd like the trust to be bigger because it would allow us to do potentially more things. And the way to do that is to, if you like, test drive it, make sure we explain what we're doing, what the new policy is. We think that we think there'll be a real appetite for a trust that does what we do, on the assumption that people believe what we're saying, and some of it is just straightforward arithmetic, and then the implications of arithmetic. If that's the case, then we would anticipate that the discount will come in significantly. I think part of it is just we keep building the track record, and then investors will find it more interesting and participate more. The other thing is that we're in a position with the reserves that have been built up that we were able to double the dividend, which I think helps. If you're just sitting waiting for something to happen and you're not getting paid for it, maybe that puts you off, but at least there's a decent yield on it now. And we've got the reserves to maintain that. So, hopefully that with what we're doing with marketing it, with talking to people about it, and when they see, the things that Alan, talked about, the strength and depth of the team that's focusing on this, we believe we're going to be able to take advantage of a lot of opportunities. We're not structural bears. We're basically born optimists. But you have to face reality. So that's what we're doing. We're trying to face reality, but being ready to change when it happens. And, as Alan said, the cash can go to zero. We could gear the trust. We'd love to. It'd be nothing better than turning around and finding cheap stocks. The time that happens, everybody's going to be thoroughly depressed because that's what will put them there. But we'll have the opportunity to do it. So I think if you put all of those things together, we can see why the discount would come in significantly, and the trust becomes more attractive to people.
Yeah, I think I completely agree with that. to my mind, it's just that people probably just don't know the story much at the moment. So
Yeah. Well, it's
and
only
it's
come
not,
together, to be perfectly honest, in the last
yeah.
5 months, really. We've been running the strategy in this way for getting on for 4 years, and I think done a decent, at least a semi-decent job of it. Decent if your glass is half full, kind of person. But we've really augmented the team in the last 6 months that's supporting it, which gives us more firepower on stocks and the ability to go and find more interesting ideas. And we've only just started talking to people about it. Sandy and I are pretty conservative. We've been, it's been run a little differently to how it was longer term. Just sort of wanted to manage it, get all the processes and everything working, and sort of compound some wealth. And now we feel like it's a sensible time to start talking about it. And at Goodhart, we're launching an open-ended strategy, which is very similar as well. I think that will help to bring some attention to bear on the trust, because it justifies us going out and banging the drum a little bit more, if you like.
Yeah, and why buy the open-ended one when you can buy this on a 20 discount?
Well, exactly. Yeah.
No, just don't help your marketing, but there we go. Brilliant. Thank you very much indeed, gentlemen. I think we've covered most questions, so we'll wrap it up there. But thank you for your time this morning, and we'll obviously follow with interest and get you back on again.
Thanks very much.
Thanks, appreciate it. Thank you.
Must show everybody your disclaimer, very important, and obviously ours too. You can obviously freeze frame those and read them properly. We'll be back next week, and we're talking to the manager of Rights and Issues Investment Trust. So in the meantime, have a good weekend, and we will see you next Friday. Thank you very much.